Yes guys, welcome back to another YouTube video. Alright, in today's video, we're going to be fully breaking down the ICT silver bullet strategy. We're going to be going over a full A to Z checklist. Alright, I'm also going to be providing you a full risk management plan that you can use for this exact strategy. Alright, towards the end of the video, we're going to be going over a few live trade examples inside of the charts. Alright, so let's jump straight into it. Alright, so as you can see here, I've done a little PowerPoint for you lot, so I recommend that you screenshot this so you can come back to it later when you are actually taking a trade. Let's start off with number one. Okay, so there's 8 steps here. So number one is you want to wait for a sweep of liquidity. All right, so this can either be a sweep of buy side or sell side liquidity. It really doesn't matter which liquidity gets swept. All right, we just want to see a sweep of some sort of liquidity. All right, number two is clear displacement. So after we get that sweep of liquidity, let's say we sweep buy side, for example, are we getting clear displacement towards the downside where price is actually displacing in the opposing direction? All right, not a shallow movement below. We actually want to see a displacement. ICT has this really good analogy when he says an elephant jumps into a pool. Okay, all of the water displaces out of that pool. So try to think of that as a good example and what you really want to look for when it comes to displacement in the markets. All right, anyways, number three, market structure shift. Okay, this is very important. You want to see displacement through either a short-term low or short-term high. All right, this really depends on the direction you are trading. So let's say buy side gets swept. Okay, we displace in the opposing direction, you're looking for shorts. In that case, you want to see a market structure shift, which is a break below a short-term low, and then you can target the opposing liquidity and take shorts. However, let's flip the example totally. So let's say you're looking for longs, sell side liquidity gets swept, then you look for a displacement higher. Okay, a market structure shift in this case would be a break above a short-term high, right? So hopefully this makes sense. Number four is the FEG, okay, short for fair value gap. Most of the people that watch my channel already know what an FEG is, okay? It's very self-explanatory, but if you guys don't really know what an FEG is, I highly recommend you head over to ICT's channel. Okay, watch the 2022 ICT mentorship. He explains it inside of there. Just a short, brief explanation. It's literally a 3-candle formation. It's the first candle's high and the third candle's low. That inefficiency between those 2 candles leaves a gap, and that's pretty much a fair value gap. All right. Yes guys, just a quick interruption. Okay, sorry to pause the video here, but I actually want to show you this week's results with the VIP signals room. All of the wins and losses, fully transparent. So let's start off with Monday. All right, we took a initial short trade here that ended up hitting TP for 40 points secured. So Monday was actually a very good day for us. Okay, Tuesday, we took a long, we got stopped out for 15 handles. We took a short trade after this that ended up smashing TP. All right, 44 points secured. Wednesday, we took another long trade, securing a little profit, all right, 28 points on the day. Thursday, we took a very quick trade that ended up getting stopped out for 10 handles, I'm pretty sure. And because it went so quick to stop loss, I didn't even get a chance to put it into the signals group, but we did take a little 10 handle stop loss on that. And then Friday, we ended up taking a short that was in profit at one point, but ended up getting stopped out for 2 handles. So very, very small loss there. And then total weekly gain for this week was around 82 handles. Bear in mind, this was actually NFP week. So most traders during these events, okay, red folder impact news, stuff like that, they performed terrible. So the fact that we even closed out in the green is very, very good. Members inside made a ton of money. Okay, we had a lot of people get funded this week also and received their payouts. But yeah guys, we have now also moved over to the Zoom platform. Okay, so the live streams are on Zoom. Therefore, there's no longer a 10-second delay as we used to live stream on YouTube. A lot of the members were complaining, saying there's a big delay. Now there's literally 0 delay on Zoom, so it's perfect. Okay, as you can see, every single morning a link to the Zoom meeting is sent in. So if this is something that you're interested in and you want to join our community, start learning ICT concepts and achieve profitability, go check out the links in the description and secure a spot right now for only $50 a month. Anyways, let's jump to step number 5. All right, so this step is actually very, very important, and it's one of the steps that most traders on YouTube, when they break down this strategy, they tend to miss this step out. I don't know why, they always miss it out. Okay, so ICT has always mentioned when you're trading the silver bullet, your times are from 10 to 11. That's your silver bullet hour during New York session. However, he does mention, if you listen carefully and you pay attention to the mentorship, he does mention to always enter inside of the 950 to 1010 macro. Okay, your entry must be inside of this 20-minute time window. And if it's not, then your trade is going to be significantly less likely to actually play out and hit TP. Okay, I'm not saying it won't. You still can trade outside the macro. I know some traders that do that. However, I personally only trade inside of these macro time windows, as it is when price is supposed to or likely to have a aggressive move higher or lower. Anyways, let's jump into step number 6. So once you enter off of that FEG, you're gonna put your stop loss of either swing high or swing low, of course, depending on the direction you are trading. Now, this is very important as well. Make sure you're not risking more than 25 to 30 handles maximum. Just make sure your stop loss is above either a swing high, the displacement candle's high, or the first candle's high. Okay, this is all if you're going short, right? But just don't risk more than 25 to 30 handles max, right? Because once you start going over 30, it's just way too much risk, and you're clearly not on side of the market. You shouldn't be risking that many handles in one single trade. Number 7. Target the opposing liquidity. So if we have swept buy side, we've displaced, market structure shift, etc. You go short, you want to target sell side liquidity. That's the opposing liquidity, right? Very, very self-explanatory. And the final step here is you want to exit all your positions before 11 a.m. New York time, all right, ideally. So if your trade still hasn't hit take profit by 11 a.m., just exit that trade. You no longer should be in any positions after that time. But yeah, guys, like I said, take a screenshot of this. All right, you can come back to it when you're inside of a trade to make sure that you're using all of the correct steps. So now that we've covered this, we're gonna jump into a full risk management plan for a 50K account example. All right, so as you can see on my screen here, we have a table. So we have trades, the amount of money you're risking, and the outcome. Okay, so this is for a 50K account example. So this can be either Apex, Top Step, any prop firm account really. I recommend Top Step, very, very good prop firm in my opinion. However, if you want to be a little bit cheaper, then you can go over to Apex. But anyways, as you can see here, all right, so let's say this is your first trade. Okay, I'm not sure why it says second, might have been some sort of typo. First trade, you're risking around 1% of the account. All right, so 1% of a 50K account is gonna be $500. Let's say that trade is a loss. Okay, you take a loss. Your second trade, you want to half your position size. Half of 500 is going to be $250. Let's say this trade is a loss again. Okay, you're on a losing streak. Then you want to half your position again to $125. And let's say you win this trade, you increase your risk back to $250. Let's say you win that trade, then you want to increase your risk back to $500. Stay at $125 risk until you get your next win. Once you get your next win, you can climb back up to $250, climb back up to $500, etc. Hopefully this makes sense. It's a very short and brief risk management plan, but it does 100% work. Okay, it will literally stop you from blowing accounts. Okay, as long as you half your risk after a loss, you're gonna have so many trades before you blow that account that it will literally be pretty much impossible to blow that account. Okay, and if you're taking, I don't know, 30 trades in a row and you know they're all losses, then at that point I'm not sure if trading's for you guys. Okay, I would say around 20 trades. Okay, you should have that room for 20 trades. Me personally, I've taken the most was around 6 or 7 losses in a row, I think. So I think 10 to 20 losses in a row, that gives you that room. So your buffer should be able to withstand around 20 losses in a row. As long as it's like that, you should be fine, guys. Yeah, screenshot this also and make sure you follow this risk management plan. Once you scale up and you start making more money trading, you build a buffer on the account, you don't really need to half your risk anymore. Just make sure your account size, okay, the total profits, you have that room to be able to take 10 losses or 20 losses in a row. As long as you have that, you don't really need to half your risk, okay? But in the beginning stages when you're starting out, I highly, highly recommend that you follow this risk management plan here on the screen. But anyways, we have covered literally everything that you need to be successful with this strategy. So all that there is to do is hop into the charts and show you some live examples. Let's get straight into it. All right, so let's start off with the first example. All right, this is gonna be a bullish example. So as you can see here, we have some very, very clean, relatively equal lows. All right, price has come all the way down, swept these lows, and now we are waiting for a bullish displacement higher. So as of the moment, I'm on the 1 minute time frame. So let's see if we can get that displacement higher. We're looking for a break above a short-term high as well. So as you can see, still no FEG, right? But we have kind of displaced higher. So at this point, I want to look through all of the time frames, right? So I go over to the 2 minute. Do I see a FEG? No. I go over to the 3 minute, still no fair value gap. I go over to the 4 minute, boom. I found my fair value gap. All right, so I'm gonna mark this FEG out. Okay, the maximum time frame I'll go to is the 5 minute. So anywhere from the 1 minute to the 5 minute is usually where I take my entries. I don't enter on the 15 minute because it's way too of a big time frame. Okay, I do the majority of my analysis on that time frame. However, I'm not gonna be taking entries on that time frame. Okay, so a big difference. Now you wanna measure from swing low, okay, to swing high, because this is quite a big price range, all right? And since there are two FEGs, right, this is a question I get asked a lot as well. You know, Ben, which FEG do I pick? Where do I enter from? Well, this is where the Fibonacci tool comes into play. So you want to measure from low to high, all right? And you want to find around 50% of that range, okay? Whichever FEG is in the discount, which is this one, that's the one you're gonna be trading. So in this case, we're gonna be taking our entry off of the lower FEG, not the higher one. Now, we wanna place our stop below the swing low. Is it inside of our risk parameters? Yes, it is. Okay, we're not risking more than 30 handles. So 27.75 handles. I recommend risking around 25 to 30 handles max. That's totally fine. Stop loss below the swing low, and then target the opposing liquidity, which is buy side liquidity up here. Okay, very, very simple. So let's see if we get triggered into a buy position here. Boom. So at this point would be long. So let's see how this trade will play out here. Boom. Okay, we get very close to stop loss there, but we don't get stopped out, and then price accelerates towards buy side liquidity and hits our take profit. Very simple trade. Okay, that was over 40 points. So risk to reward there is around 1 to 2. So that's example number 1. That's a bullish example. Now we're gonna be going over a bearish example. All right, let's get straight into it. All right, so finally I've found a bearish example here. All right, it just took me ages to find this because the market has been so bullish lately. But anyways, I found one, so let's get into it. Number 1, okay, wait for a sweep of liquidity, which we have clearly seen here. Okay, we swept buy side liquidity, all right? Step number 2, we're gonna wait for a clear displacement and a market structure shift. So what is a market structure shift? As you can see down here, we have a short-term low. Okay, this is literally a swing low that gets broken through. That's a market structure shift, all right? And we have clear displacement as well because we have left a inefficiency behind in price, all right? So this is our FEG here that we're gonna be taking our entry off. All right, so short off there. Can we do a stop loss above the swing high? All right, it's over 33 handles. Hence, this is not in our risk management plan. We're not gonna be putting our stops there. What's the next logical stop placement? All right, it's the first candle's high here. All right, so it's 28 handles, it's in our risk parameters, therefore we can put our stops there. Let's say this was actually over 30 handles and we couldn't do it. Where is the next stop placement? The next stop placement is going to be the displacement candles high, right? That's the minimum stop placement you should be doing. But in this case, we're going to be putting our stop placement just above that candle there, okay? And then of course, you're going to target the opposing liquidity, which is down here. So there you go. Let's see how this trade plays out. All right. There we go, you get tapped in to that short entry there. Now, notice how your entry is actually inside of that 950 to 1010 macro there. Your entry is exactly inside of that window. How weird is it that these setups always happen between these time windows, right? Isn't that strange, guys? But let's see how this trade plays out. Boom, TP smashed. Too easy, right? And I hope you got a better understanding of this strategy. This is also the strategy that I use to trade inside of our community. Okay, we have over 200 members that trade live with me on Zoom. Okay, we also send in the signals through a Telegram chat. So if you can't tune into the live streams, you always get them live signals directly to your phone so you can make money with us. Now, if that's something that you're interested in, make sure to go check out the links in the description and go secure your spot right now for only $50 a month. Anyways, guys, please leave a like, okay, leave a comment, share and subscribe, and I'll see you lot in the next one. Take it easy.